Hey everybody, Derek Alexander here, and in this video, I'm gonna break down an array of different investment options that are for beginners. If you're like most people, you're probably wondering how to get started with investing, but the idea of it just feels way too intimidating. You don't know where to even begin. Well, do not worry, because in this video, I'm gonna break it down for you step by step. But just understand this is not financial advice, and before investing in anything, you should always do proper due diligence and assess all of the risk that comes with that specific investment instrument. This video is going to be able to help people break down and discern all the different types of investment options that are out there so they can make a better informed decision and weigh out the pros and cons that fit their own specific risk appetite. So let's get started. So let's just start with savings accounts, which many people view as a great place to store excess cash, but some view as a unique investment opportunity to grow their wealth. And those people are called dinosaurs. No, I'm completely kidding, but they actually are a pretty good ideal place if you have a really low risk appetite to just store your money. They are FDIC insured up to $250,000, and you can just feel safe knowing that your money's in a good place with, a traditional bank. Additionally, one thing too to think about with savings accounts is they do offer a higher interest rate than a normal checkings account without having to take on any penalties when you have to withdraw your money from day to day or month to month. The thing is though, if you're in the 1950s and you want to scale your money with a savings account, it could be a safer bet because interest rates were much, much higher back then. But banks have been offering a very, very, very small interest rate with savings accounts for years, and it's actually getting slower and slower. Just to give you an example with this, in 2010, the average interest rate that you would get on your money being in a savings account was 0.2% per year. 12 years later in 2022, it's half of that at 0.1% a year. Just putting this context, what it means is that if you had, let's say like $1 million, it would take you 8 years to make $100,000 on that $1 million. Ouch, that is rough. If a savings account sounds too low interest for you, one option that you might consider is what's called a money market account. Money market accounts are basically savings accounts that offer higher interest rates than traditional savings accounts that you would find or that you may already have your money in. This means that you can earn more on your investment in a money market account than you would with a regular savings or checking account. However, there are a couple downsides with money market accounts as well. One is that they typically have higher minimum balance requirements than a regular savings account, which means that you'll need to have enough money saved up before you can actually open one of those accounts yourself. Additionally, money market accounts also have normally a limit to the number of transactions you can make per month. So if you're looking for an investment you can frequently withdraw back and forth, then that may not be the best bet for you. But overall, money market accounts can be a good investment option for people who are looking for a relatively safe, maybe lower investment tier with their own risk that don't mind having a minimum balance that are required to put their money into. But if you're looking for an investment you can frequently trade back and forth, then you're gonna wanna look somewhere else. Another option is certificate of deposit, also known as a CD. Similar to a savings account, they are FDIC insured, but unlike a savings account, they do have a typically higher interest rate, but they also have a set maturity date, which means you can earn more money on your deposited funds, but you're going to be unable to access that money until the CD has reached its maturity date, which really gives it some pros and cons. The biggest pro is that CDs are pretty low risk. You just deposit your funds, they're FDIC insured, and then you know that your money's safe even if for some weird reason the bank fails. But the biggest con is that you can't access that money until the CD is done, meaning if you have an emergency situation, you need to make a withdrawal, you really can't. Overall, CDs are a good choice and a good option for people that have a low risk appetite, but it really just depends, but you have to make sure that the CD you choose is the right maturity date for your own specific needs. All right, so we're leaving the Jurassic period talking about savings accounts and money market accounts, and we're gonna dive into the stock market, and we're gonna start with what are called blue chip stocks. If you don't know already, blue chip stocks are a type of investment that refers to the stocks of a large, well-established company that have a history of making consistent profits year after year. So while blue chip stocks are often seen normally as a safe investment, there are a lot of pros and cons to consider when you put your money in a blue chip stock. One of the biggest benefits of blue chip stocks is they tend to be a little less volatile than other types of stocks that you may find, meaning they're less likely to experience huge swings in the market with their value, which would make them a relatively safer investment, especially for those who are risk averse. See, blue chip stocks also pay a dividend to their holders year after year, which can create a steady stream of income. But in order to really benefit from that, you're going to need a lot of capital in those stocks. Now, one of the biggest drawbacks of blue chip stocks is that because they are stable, they also offer a lower potential in returns than other investments. For example, a blue chip stock might only increase in the value of a few percentage points in 1 year, whereas a more speculative investment could potentially double or triple in value in that exact same period of time. So then as a result, blue chip stocks may not be the best choice for investors that are looking for a higher risk investment that has a faster rate. If you're trying to find faster gains and higher gains in a shorter period of time, then you may be looking for penny stocks instead. One, penny stocks are volatile, which means they can go up or down very rapidly. And this makes them a very risky investment, but it also means that there's a huge potential for large profits if you pick the right stock. Penny stocks also are incredibly liquid, which means it can be very difficult to sell your shares when you want to cash out from that stock. People don't realize that penny stocks are often penny shares of companies that are in trouble financially, which means that the company may not be around for much longer and your investment could disappear overnight. This is where you're going to have to really exercise proper discernment and study the companies like crazy before you pull the trigger on that stock. Analyze those companies and really make sure you research them. If you don't want to spend all that time doing the research, then you also get involved in a fund where other people can manage those different stock assets for you. Funds that manage your stock assets are like a 401k or a Roth IRA. Here's where 401k comes in, which are really popular ways to save for retirement when the individual isn't confident in their discernment to choose what stocks to make money in. One good thing about 401ks is that they offer tax advantages. As you contribute to a 401k, you can get pre-tax dollars on the money as the account grows tax deferred. This can lead to a significant amount of tax savings over time. The second thing is that 401k accounts offer employer matching contributions. So this can be a great way to boost your own investment returns if you work a traditional job or work for a specific company for years and years. The last thing about 401k accounts though is that they typically have very low fees. It's important though because high fees can really eat away at your investment year after year over time as you compound those fees and see how big they can get if you have a 10, 15, 20 year investment. Now some of the challenges with 401ks is that you may not be able to access that money in your account until you actually retire. This could be an issue if you need to get that money for some type of unexpected expense or withdrawal that you need last minute. The other thing about that is you may be subject to early withdrawal penalties if you do try and get that money really early or before you actually hit your retirement age. So make sure whatever you put in there, you are not touching until you are truly retired. Another option is a Roth IRA account. The plus side of a Roth IRA account is that it is tax-free growth potential, which means that you won't have to be subjected to pay taxes on any of the money that you make on that investment, which could really add up if you have that for 20, 30 years. The additional part of a Roth IRA that's great is that account holders can withdraw their money at any time, unlike a 401k, without a penalty. So the flexibility of that can be really handy in case an emergency pops up. You have no issues being able to withdraw that money for whatever purpose you need. The only downside with Roth IRAs is that you are required to pay the taxes on that money you contribute up front. So what that means is if you're withdrawing your money too early, then you may not get all of the benefits of it back. Additionally, Roth IRAs have contribution limits, meaning if you're trying to invest a large sum of money at once, it may not be the best option for you. But Roth IRAs and 401ks could be a great option if you're wanting to have something that is almost like a set it and forget it, where it can compound, be stable for the long term, and be a great 40-year plan that you can sit back on and really have a semi-normal trajectory in your returns. All right, so you probably already heard about this from your grandpa or your dad, but we're gonna go into what are bonds. When it comes to finance, bonds are notorious as the stable but kind of boring investment option. One of the biggest benefits of bonds is their predictability. Unlike stocks or crypto that can be very volatile and change in value wildly from day to day, bonds are kind of just steady, which makes them a pretty ideal investment for someone that's looking for a predictable return, but maybe not super high return. The reason why is because bonds offer a fixed interest rate. This means that you know exactly how much money you're going to make on that bond with your investment over that period of time. This could be helpful if you're planning your finances and trying to ensure that you'll have the money you need when you need it in that allotted time. But one of the biggest risks that people see with bonds is that inflation in the markets can actually eat away at your returns. If the cost of living goes up, but the interest rates on your bonds stay the same, then your investments will slowly lose value over time. And in today's economy, it's probably going up. So if those interest rates keep rising, the value of your bonds will keep going down, which means that in today's economy, there is some unpredictability with bonds as an investment choice. Okay, we're gonna talk about real estate and we're gonna start with flipping houses. And I think most of us can agree that real estate is an incredible investment, but there is a lot of things that you need to consider before you flip your first home. The first is the fact that it takes a lot of time and effort just to find the right property, as well as the right contractor, the right real estate agent, really the right team to guide you in that process. You're also going to need to be prepared to accept the fact that the project itself could take a lot longer and to cost maybe even a lot more money than you anticipated when you first started. That being said though, if you are willing to put in the work, flipping houses can be a great way to make money in real estate. And if you do it right, you could even end up making more money than you would have if you simply just bought a property and held it for the long term. If you are thinking about flipping houses as an investment full time, what I would do is find someone who's already has a prior track record flipping homes and has been profitable long term and partner with them. That way, they can benefit from the investment capital that you would bring to the table, and you could benefit from their expertise in finding properties with their background in market research with those different homes. Now, if you don't have to do all the flipping, you could just buy and hold homes. Similar to stocks, you can always just hold real estate as an asset. There are a lot of reasons why this strategy can be really appealing for people. One is real estate historically as a physical asset has grown over time. It also can make it feel more tangible when you have a physical asset that you can actually go inside of. The other thing is real estate can offer the potential for steady income through the rental payments that you can get as you let people live there as a lease. This property can then go up in value, but you also can be getting cash flow to pay down the mortgage at the exact same time. One big limitation for people is that real estate can be very expensive as an investment. So you need to have a significant amount of capital to really get started. Now, if you want to use the method where you buy properties with no money down, you're gonna have to do a lot of research and understand how to manage debt correctly so you don't get too deep in the red on your journey of trying to use the bank or some institution's monies to get these homes. The other thing is real estate is relatively liquid, which means it can take longer to sell properties. And if you need to access your money right away, then you may be in a really tight spot. So lastly, real estate is great for a long-term investment, but you need to be prepared to commit to holding those properties for many years in order to see the greatest return on your investment. And that's going to require a lot of patience, a lot of discipline, and a lot of other income from different types of businesses, job, investments, whatever it may be that fits you. A simpler option in real estate could also be a real estate fund, which is an investment vehicle that pools together money from multiple investors to purchase real estate properties. These investors in real estate funds typically earn a return on their investment through a percentage of the profits that are generated from the sale of the properties or through the rental income of the people that are renting out the properties. While some real estate funds offer a number of different advantages, there are some things you have to consider before putting your money in these funds, like knowing the people that are actually running them in the first place. Is it an established company? Is it a brand new company? But one of the main advantages of real estate funds is they do offer diversification. See, by investing in a real estate fund, you can actually gain exposure to a wide range of real estate assets without having to go out and purchase each individual property yourself. And this can be a really good way to mitigate risk and provide a steadier return over time and sprinkle your investment in other spots. The other thing too is they have attractive tax benefits, because in a lot of different cases, these investors in real estate funds can deduct their depreciating expenses from their taxes, which could then create a significant tax savings over the years that they have their money in that fund. And like anything, there are some potential drawbacks to consider before investing in a random real estate fund. One of the biggest would be making sure that that fund itself has underlying real estate assets that do not decline. See, this can lead to a host of problems if that real estate fund is picking different investments that are going to go down in value. The other thing is making sure that the funds are not highly leveraged, meaning that they borrow money to finance these purchased properties, but they're financing way too many properties and they're borrowing way too much money to a point where they won't be able to pay back these loans they're trying to get, whether that's through a bank, an institution, or your capital. All right, so we're talking about cryptocurrency, and when it comes to crypto, there are a lot of things that you need to consider. Should you buy and hold? Should you trade frequently? What coin should you even invest in? And perhaps one of the most important things is cryptocurrency as an investment going to be here in the next 10 years and be successful, or is it all just really speculative? The thing is, cryptocurrency is relatively new and it's going to have a lot of volatility in terms of the actual market conditions. You're going to have coins that go up in value and coins that go down in value. But that being said, cryptocurrency also has the potential to generate a tremendous return. Just as an example, in 2017, the price of Bitcoin surged from around $1,000 to nearly $20,000 before going all the way back down to $3,500. So there's no guarantee that any type of income is going to be set. But holding cryptocurrency in the past has made a lot of money for people if you just held it for the long haul. But if you're going to do that, be sure to actually research every single coin you're going to get involved in and be diligent and disciplined enough to hold those coins, knowing that they may go backwards in their price as well as upwards. One option that is often overlooked with cryptocurrency is cryptocurrency staking. Staking is a process in which holders of cryptocurrency can earn rewards for keeping their coins in a cryptocurrency wallet. By staking their cryptocurrency, they earn an interest on their investment as well as rewards for participating on the network and helping secure it. There's a number of benefits in staking cryptocurrencies, including the potential to earn passive income and the ability to participate in different types of governance of that cryptocurrency network and the opportunity to help secure the entire network, which brings in another community of people that can also build your own network of other opportunities that may lie in future cryptocurrency coins. That being said, there are also some risks associated with staking cryptocurrency, including the potential for loss of principal and the possibility of missing out on potential gains if the price of that coin does fall. fall. But that being said, staking crypto could be a great way to get passive income in that specific coin if you believe the utility of it and want to hold it for the long term anyway. Many people think crypto is a volatile and risky investment, but a lot of people don't even know all the different ways you can trade crypto, and one is futures trading. Futures contracts are agreements to buy or sell an asset at a set price at a future date. So as an example, you might enter into, let's say, a contract to buy Bitcoin at $10,000 on January 1st, and if the price of Bitcoin on that date is above $10,000, then you'd make a profit. If the price is below $10,000, then you'd incur a loss. So crypto futures trading can be a great way to actually make money if you know what you're really doing. But there's a lot of people that don't know what they're doing, and it's important to remember that it is all speculative. No one can actually predict the price of these coins. You have to look at the prior history of these coins and make sure you have the necessary understanding to make those trades. Similar to 401ks or Roth IRAs being funds for stocks where people can manage that money for you, and similar to the idea of real estate funds that I was talking about earlier where people just manage your properties, there's also cryptocurrency funds where you can park your money with a team of people that are going to manage your capital, and you don't have to spend as much time having to take every single trade or figure out what buy and hold strategy you need to do with your money. The benefit of this is kind of ease of use. You can park your money somewhere and let them trade your crypto. The negative is if you don't know that institution well, there could be some risk if they're going to take volatile trades or have a strategy that doesn't really match your own risk parameters. The other thing is regulation. There's not as much government oversight on crypto, and since it's decentralized, a lot of companies are coming up and wanting to manage lots of people's money. So if they're going to manage your money, make sure that you know the trading strategy that they're using and it's a strategy that you like, whether that's selling, buying, holding, staking, whatever it may be. Know that strategy and don't just take their word for it. See actual history of trades so you can feel confident and validate that these are people that you feel comfortable having your money with. So the last financial market we're going to dive into, and one of my personal favorites, is Forex. So when it comes to Forex, there are pros and cons that you got to consider if you're going to invest. The plus side of Forex is that it offers a ton of opportunity for growth. The market's huge, it has daily turnovers over $5 trillion, and that means there's always room for profit in those markets, and it's also incredibly liquid, so it's easy to get in and out of those trades. And because it's a global market, it can trade 24 hours a day, 5 days a week. On the downside, Forex can be super volatile if you're not prepared. That means prices can move just as quickly down as they were gonna go up, which means you could have a lot of losses if you don't have stop losses and risk protection set in place. See, trading Forex means you have to be able to understand your risk appetite. This is where you're going to be able to have to magnify different types of wins and different types of losses to make sure that you have your emotions best suited for you. The downside of Forex is that sometimes it can be a very volatile market where prices are moving quickly and unexpectedly that can incur losses from time to time. There's a lot of leverage that's being involved as well in Forex trading, and that can magnify your losses, but also it could magnify your wins as well. So there is a lot of earning potential, but there is a lot of risk if you don't have proper risk parameters. The other thing you want to realize is that because Forex is a large decentralized market, it is difficult to get reliable information sometimes, and it can be difficult to get informed decisions and realize what products actually exist and can be successful and what ones could be dangerous. This is where, for at least my company, Market Hackers, we've been able to take a lot of time, I'm talking years, allocating into a ton of different types of platforms and products to really identify through testing which ones can be the best for our customers, where they can have the best trading experience in the foreign exchange markets with the goal of incurring the littlest amount of risk that's possible. All right, everyone, so in this video, we've looked at some of the pros and cons of a ton of different investment models. But overall, there's no right or wrong answer when making the decision to learn about where to invest your money. It's not going to be something you achieve overnight, but reaching a point where your passive income from your investments cover all of your living expenses can be a lifelong pursuit for a lot of people. But one thing that I personally know for sure is that the very fact that you're pursuing it separates you already from a ton of people in the world who let circumstance dictate their future day in and day out. So I want to thank you again and really appreciate you guys for staying along this video and watching the whole thing. And just make sure that you drop a like, turn on post notifications, and if you have not already, subscribe to my channel for more insights on business, finance, and everything entrepreneurial. All right, bye for now.
Could be the